Hello and welcome. In this video, we will see what hedging is. Okay? Now, let us say that this is you, and in April 2015, you had bought stocks of Hindalco company. Okay? Hindalco company. Now, this is a company. And let us say you had bought 1000 stocks at 100 rupees each. So basically, you had paid 1 lakh rupees to buy 1000 stocks of Hindalco in April 2015. Okay, so this was your investment. Now, as time passed, the value of the stocks or the company increased, and currently, let us say the date is April 2nd, and on April 2nd, 2023, the market price of Hindalco stocks is rupees 500. Okay, so this is when you had bought 1000 stocks at 100 rupees. This was the market price then, and today on April 2nd, the market price is 500 rupees. So your 1 lakh rupees of investment has become 5 lakh rupees now. How? 500 into 1000. Okay, so this is your wealth or portfolio now. Now, let us say that you are analyzing the stocks of Hindalco, and according to your analysis, the price of Hindalco will fall from 500 rupees to 400 rupees by April 20th. Okay, today it is April 2nd, and according to your analysis, the price, which is currently 500 rupees, will fall to 400 rupees by April 20th. Okay. Now, if this happens, what happens to your portfolio? It will decrease by 1 lakh rupees, correct? Which is not something that you want. You want to protect your portfolio. So, what can you do? What you can do is sell all your stocks. How much stocks do you own? 1000 stocks. So sell all your stocks at rupees 500 on April 2nd, which is today, and then buy those 1000 stocks at rupees 400 on 20th April. So according to your analysis, it will decrease to 400 by April 20th, correct? So sell everything now. By selling, you get 5 lakh rupees, and then buy the same amount on April 20th for 400 rupees. So you can do that. This is feasible, but people do not do this. Okay, they do not sell everything that they own and then buy them back. Okay, so there are taxing issues too. There are brokerage money that you have to give. There are many other factors due to which people do not sell this. If we take your example, you had bought it in April 2015 and you have been holding it till this year. Just because it is falling from 500 to 400, you do not want to sell everything now and buy it on 20th. Okay, even though this is an option, you do not want to do this. So what is the alternative? Alternative is to short April futures at rupees 500. What do you mean by shorting? Selling. Correct? I had mentioned about going long and going short. Going short means selling, or shorting means selling. So this is one more option that you have. You can sell April futures at 500 and hedge your shares. Okay. Now when do you sell futures? When you believe that the price of the stock will go down, correct? So that is when you sell April futures. So this is what you can do, and by doing this you protect your portfolio against the decrease in value of price. Okay, now let us say that Hindalco April futures is what you buy, okay, is what you sell, not buy, sorry, is what you sell. And let us say that the lot size of Hindalco is 500. How many stocks do you have? You have 1000 stocks, correct? What is the lot size of futures, Hindalco futures? It is 500. So you need to sell two lots. You need to sell two lots to protect your portfolio. Okay, so we'll see side by side comparison. Do not worry about it right now. Okay, so you decide to sell two lots of Hindalco April future, and the expiry of the futures is 27th April. What is the date today? Today it is 2nd April. Okay, the day of your analysis. All right. And out of these two options, you decide to go for this. Okay, and remember that you are selling April futures while holding the stocks. It is not that you are selling this and also selling this. No. While the stocks are still in your demat account, you sell April futures. Okay. Now let us see what happens in two conditions. One is the price falls. This is first condition. So price falls according to your analysis. So your analysis was right and the price fell from 500 to 400. That is the first condition. So let us see what happens. Now stocks is on the left side, futures is on the right side. So you still have stocks in your demat account. Okay. So on April 2nd, this is the market price and this is the portfolio. And on April 2nd, the market price, let us say, is 500, and you decide to sell two lots of April futures, Hindalco futures, by paying margin money. Okay. Now, let us say that on April 20th, the market price of Hindalco stocks is rupees 400. So your analysis was right. The price fell from 500 to 400, and so now your portfolio is this much, 4 lakh rupees. Okay, so 5 lakh was on April 2nd, 4 lakh as of April 20th. How is it 4 lakh? 400 into 1000 stocks that you own. Okay, so futures price also fell. So now when we calculate loss and profit, the loss here is 5 lakh rupees, which was on April 2nd, minus 4 lakh rupees, which is as on April 20th, and the price is 1 lakh. So loss is 1 lakh rupees. So you lost this much in stocks. Okay, whereas this coming here, profit is 100 into 1000, which is 1 lakh rupees. How is this 100? So 500 minus 400 is 100. What is this 1000? Number of stocks, two lots, correct? 500 plus 500, 1000. So 100 into 1000 is 1 lakh rupees. So you lost 1 lakh rupees here in your portfolio, but you gained the same amount in futures. And by shorting this, you were able to protect your portfolio. Okay, you are able to protect your portfolio. Now remember that this will not be the same amount. It will vary. Okay, it will vary. It will be slightly more than 1 lakh rupees. It will be slightly more than 1 lakh rupees. But I have taken the same values. Okay, just to make you understand the concept. Okay, so you wanted to protect your portfolio, and so you sold the futures. So whatever you lost in stocks portfolio, you gained in futures. Okay, and let us say that you analyze the stocks once again, and according to your analysis, from April 21st, the price will move up. Okay, the price will move up. So what do you do? On April 20th, you close this. Okay, you close this. So you have 1 lakh rupees which you can keep, or you can buy the stocks of Hindalco, and as the price increases, the portfolio also increases. Okay, or wealth of you will increase. All right. So that is one thing. That is one thing. Now, see, the price of stocks will keep on moving up and down. Okay, it will move up, come down, move up, come down, move up, come down, move up, come down, and so on. Okay, so generally people do not get scared if they invest their money in stocks. Okay, so when they invest their money, they know that it will come down, go up, come down, go up, and this will be there. Okay, but sometimes the fall may be very large due to many reasons. The company may go in a loss, or there may be a government policy, or a country to which the company is exporting may be at war. So there are many reasons due to which there may be a large decrease in price. So at that time you need to go to future selling like this. Okay, future selling to protect your portfolio. All right. So other than that, if the price fall is very small, people do not do this. Okay, and then generally institutions do this. Okay, the process of hedging. What is hedging? So you sell something to protect something that you have. So here you sold futures to protect the value of your portfolio. So this is called as hedging. Okay, and generally big players and institutions do this. We as retail investors do not do this normally. Okay, because generally we will not be having 1000 stocks too. Correct? Yes. So this is first condition. Now let us see the second condition. Second condition is when the price rises. Okay, so now here your analysis has gone wrong. On April 2nd, this was your portfolio. You thought that the price will fall. Okay, you thought that the price will fall. And what did you do? You sold 2 lots of Hindalco futures. Okay, Hindalco futures. But then your analysis was wrong. Okay, so see, in market, no one can be 100% accurate. All right. So many a times your analysis may be right, sometimes it will go wrong. All right, and now we are assuming that it has gone wrong. So you thought it would fall, but it has raised. And by April 20th, the market price was 600 rupees. So it was 500 on April 2nd, but it increased, it raised, there was good news, and the company was in profit, so it increased to 600. So currently your portfolio is 6 lakh rupees. So here you have sold the futures, correct? So when you sell futures, you only make a profit when the price decreases. But here it has increased by 100 points. So now if we check the profit and loss, we have made 1 lakh rupees profit here. 6 lakh rupees current price minus 5 lakh rupees the previous price, not price, value. Okay, so we have 1 lakh rupees profit here, whereas here we have 1 lakh rupees loss. So 100-point difference into number of stocks, 1000, 1 lakh rupees loss. So whatever profit you have made here is lost here, but then your portfolio remains same, or the value remains same as that of this, because your analysis went wrong. Okay, your analysis went wrong. Whereas in the previous case, the analysis was right and you were able to protect your portfolio. Here, your analysis went wrong, and so whatever you gained here was lost in this case. And this process is called as hedging. Okay, this is called as hedging. And as I have mentioned, hedging is generally done by institutions or those with large amount of stocks. Okay, it is done to protect their portfolio against the loss. All right. Yes. So I hope the concept is clear. I'll see you in the next video. Till then, take care and thank you for watching.